In this video, I want to walk through your second team project where you value a company of your choice. I'm going to value Walmart, whose ticker is WMT, which means your team cannot do Walmart. What I recommend that you do is you pick one of the companies that one of your team members did for the financial analysis individual paper, the first thing you did in the class, and you'll see why it's good to have that data to help you with this project. But let's step back. I'm going to break this up into a few videos so you can focus piece by piece. It really is a building block approach where you have several inputs that you need to value a company. You want to think deeply about each one as you go. And have documentation and support for each assumption. At the very end, it is a subjective analysis. There is no definitive value of a company. You may hear people talk on the TV or in articles, see them writing in articles about the true fundamental value of a firm, but no one really knows what a Walmart is worth. It's very difficult, so it's a subjective number. That's why I so strongly recommend using the data tables we talked about in one of your financial applications where you valued a couple of stocks and created data tables. So I want you to do the same thing here, because I do not think anyone really knows the true value of a firm, but we can definitely get some comfort about a reasonable range. And that reasonable range for Walmart will probably be much narrower than a reasonable range, say, for a Tesla or for a Google, where there's a lot more uncertainty. But even Walmart, Walmart was competing against Sears and Kmart and Montgomery Ward back in the early 80s, and no one was really thinking about Walmart at all. Sears was the big up and coming, taking over, just a firm that took over Kmart as the largest retailer. People were writing articles about how incredible this firm was, how well managed it was. And here we are 40 years later, and Sears is combined with with Kmart, and Montgomery Ward and many others are going out of business. We're seeing Macy's and JCPenney and many other stores struggling. And Walmart then became the darling of Wall Street, but now Walmart's being almost taken out by Amazon. It's incredibly difficult to forecast out 20, 30, 40, 50 years. So it's going to be subjective. You're not going to have great confidence in a point estimate, but hopefully you'll have some confidence in the range estimates, realizing something dramatic could happen that you didn't forecast and the whole firm go under, just like we're seeing with Hertz Rent-A-Car this summer. So what do we need? So let's start back with the inputs. If we know all the inputs, then we'll have a good roadmap for where we're going. So the first input is the discount rate, what we refer to as the KE, the cost of equity capital. That's the discount rate we're going to use to value this firm. And we are going to use the capital asset pricing model. Not that it's the only model out there, but it's the most common model, and there's really, just for the sake of time, the other models are quite involved, quite technical, many variables. And I'm not really sure there's any evidence they're all that much better than this very simple model. So if you remember this model, it says that the discount rate for a stock equals the risk-free rate plus beta times the market or equity risk premium. So there we have three things right there that we need. We need a risk-free rate, we need a market risk premium, and we need a beta. Now the beta, you will do the beta exactly like you did it in the financial application where you came up with the beta for a firm of your choice, where you have those 4 steps. I'll do that again here with Walmart, but that's what we'll walk through the process again. So some of this will be repetitive, which is actually very good to get some practice with something that might be very new to some of you, the value of firm. The risk-free rate, there's a lot of debate about this right now, but we're going to keep it simple, and we're just going to use the current 10-year Treasury yield, which we can get from Yahoo Finance. So that one That one is very simple. That's the easiest one. You just look it up. The market risk premium, I'll show you how we're going to do that. We're going to use what's called the implied approach, which is not only is it one of the easier ones to use, but it's also the most common approach, and I think theoretically the best approach. And then beta, we'll use our 4-step process. And once we do that, we will have a discount rate. Of these 3 numbers, betas we want to do scenario analysis on. Because on these other 2 numbers, the risk-free rate, market risk premium, remember we're going to use the same number no matter which company we're valuing, as long as it's a U.S. company and a large company. There are some risk premiums people add for smaller companies, or risk premiums for just different countries, but we're looking at large U.S. companies here, so we'll use the same market risk premium for every company and the same risk-free rate for every company. And so the real uncertainty for your company in comparing its valuation to valuations for other companies is its betas. So when we talk about creating that data table again, just like you did in that application and doing the stock valuation, we vary the beta and we vary the growth rate. So that's where we want to do our analysis. So there's the first input, the discount rate. The second input that we really need is the growth rate. Now really what we're talking about here is dividend growth rate, but we're going to say that that is essentially equal to the earnings growth rate. What that implies is that you can only value firms that pay dividends. So if you want to do a firm that is not paying dividends, I can give you a substitute for that number. So if you want to value a firm like Google that doesn't pay dividends, or Facebook, and I actually can't remember right now what Facebook's dividend policy looks like. It might be Apple does pay a dividend, but it's a very low dividend relative to their earnings, so it probably will not give you a good valuation. So there is a substitute number we can use. We'll probably talk a little bit about this in class, or maybe you already have, about substituting a free cash flow number for the dividend, and I can certainly give you that number. So if you choose a firm that doesn't have a dividend, or its dividend is very small relative to its valuation, to its earnings, then let me know and I will get you a substitute number that you can use for the dividend. But the growth rate we're looking at is really, most people focus on the growth in earnings and just assume that dividends will grow in lockstep with earnings. So to do the growth rate, there's a few inputs here. There's a subjective analysis, that is your opinion. How fast do you think this firm will grow? There's a few inputs we could certainly use here. So one is, what is the drivers of growth? And what are those drivers doing? So there's some relations to that. So one might be demographics. Maybe you have a product, let's say you're doing a firm that does medical supplies or medical equipment. And your medical equipment is maybe equipment for hip replacements, or maybe it's pacemakers, or something that really is tied into the baby boomers, the older population. Then you can certainly go and get data on how fast is that population growing. We know the baby boomer population is growing fast, but eventually, 20, 30 years from now, it will start declining because we had somewhat of that drop in the 70s in birth rates. And then you have the Echo generation, which is the grandchildren of the baby boomers. So, look at the demographics. That's one of the easiest things to forecast, which is demographics. We have a pretty good idea of how many people will be alive, how many 60-year-olds there will be in 20 years, because we have a pretty good idea how many people will die. We know what birth rates are and all kinds of things. So demographics is not a bad approach at all. We can think about their markets. Is it U.S. only? Are they expanding? So what what are they doing? There's new uses for existing products. There's a lot of things that you can get there. So if you get at a company like Netflix or Disney, they're definitely expanding their business. They're starting to do more product development. You look at like an Uber that's starting to do delivery of groceries and food, and there's a lot of things that firms could do that could get them some growth. We'll talk some about that with Walmart. You have to think about, one of my favorite topics is disruptive innovations. Either your firm is this disruptor, they're coming in and they're going to essentially plow over an existing market, or if your industry is being disrupted. So one of the issues I think about disruptive industries is very much the autonomous vehicle. Autonomous vehicles, they're not taking over the world quite as fast as people used to think. But these driverless cars could definitely disrupt the property and casualty insurance industry if people stop buying cars and they use shared services. Certainly banks with auto loans, certainly auto manufacturers. There's a lot, even the airlines industry and others could be really disrupted by that. A firm like Valero, if we move more to electric cars, what will that mean for gasoline or for oil companies? What does solar and wind mean for oil companies, and what is fracking doing? So what are those disruptive innovations out there? We talk about artificial intelligence, robotics, nanotechnology. There's a lot of them out there that could really radically change industries. We've even seen with COVID-19 changing the way people do things. I've had my first doctor visit, which was online. It was a virtual doctor visit. I love it. I'm trying to convert most of my meetings to Zoom meetings, so I don't have to drive in. Driving's, can be 45 minutes to an hour in my day just to get to a meeting and meet with people where I could easily do Zoom. So how are these disruptive innovations changing things? Hopefully you've had Porter's 5 Forces. That's really looking at industry attractiveness. And I know Bruce covers that, so I'm not real sure relative to this project exactly where you get there, but some of you have probably had Porter's 5 Forces before. Things like buyer power, supplier power, rivalry within the industry, substitution effects, entry barriers, exit barriers, all those things we've talked about, what makes an industry attractive. I think probably better for this project is the idea of economic moats. And we'll talk about that some in class. I have a presentation I like to do to go through those. It's closely tied to Porter's 5 Forces. However, Porter's 5 Forces is really focused on industries. This is more focused on companies. And what we're looking here at is sustainable competitive advantage. A firm that is growing fast, how can they continue to grow fast and keep the competition out? So that's an important focus. You can think about market share. Is your firm gaining market share? And if it is, from whom are they getting their market share? So if firms like Family Dollar and Dollar General, if they're gaining market share from Walmart, then why is Walmart allowing them to do that? What will Walmart do in reaction? Do they have an economic moat that will protect them from any reactions? So that's a subjective part. There's many different ways you can go from this for your company. Hopefully somebody in your firm and your team has a good insight into these companies. The next thing you have is you do have some actual ballpark numbers you can use. And we'll look at some of these. One is just historical growth. How have they grown in the past? So we'll look at that. You have those numbers from your first individual case for your company, so we can easily go back to that case and look at the numbers. There's what finance calls is sustainable growth. I'll show you that formula, very, very easy formula to use. I'm not sure that it's a great number to use, but it's definitely tied to this idea of turnover times margin. We talked about that. Is this firm, and when we did the first paper, the individual project, the importance of a firm improving its asset turnover, improving its margins, or both. So what is this firm doing? Sustainable growth assumes turnover and margin are constant, that they don't change over time. But sustainable growth, if a firm is improving their turnover, improving their margins, then their sustainable growth will actually be growing over time, so they can actually grow faster in the future than they have in the past. And the last one we'll talk about is what we call the PEG ratio approach. And essentially what this is what do stock analysts believe? Now obviously you're using somebody else's assumptions there, but what do you believe? And so what do you believe versus what do they believe? Or maybe you say, they know more than I do. They've been analyzing this firm, so let's look at what they believe and we'll use their numbers. There's obviously a lot more that you could do. You could do a lot of research. There's just a lot of what you did with paper 1. Looking at the history sets you up to forecast this company. What we're trying to come up with is 2 numbers. A short-term growth. What do you think, say for the next, who knows how many years, 5, 10 years, and a long-term, what we call terminal growth. When this firm gets through that short-term period, maybe they're expanding overseas, or they're a new startup firm like an Uber or Tesla that has a product that they're hoping to have really, really high growth, but eventually they saturate their market. What's that growth rate when they become a normal growth? And that terminal growth we're going to tie to economic growth. Eventually, Google, Apple, Amazon, eventually every firm will just grow in line with the economy, maybe a little slower, maybe a little faster. So that's where you have for the growth rate. And then the last thing, you just have inputs. And the inputs tend to be pretty straightforward. Really, the main input we're going to have is dividend 0. So just what is their dividend today? We'll get that from Yahoo Finance or from me. If you do a firm that doesn't have dividends, I'll get you a number that you can use. That's really the main number we have. So there are a few places. A good example, there's a risk-free rate where we'll just pull that number in. Dividend 0, we'll just pull that in. So there are numbers. Most of these numbers in this formula, we're going to have to do some analysis. And then you have the formulas. And on the formulas, I'm asking you just to do 2 of them, just like you did in the application. We're going to use the dividend discount model, and we are going to use the H model. So I say 2 numbers on growth. 2 numbers on growth, you need the short-term growth and the H. So the H model tells you how long does it take to get you from that short-term growth to the long-term growth. So we need some timeline, some forecasted time period for that short-term growth. So there's where we're going. So what I'm going to do in this video, on these videos, is I'll walk you through each one of these. You've already done it before, so you may already feel comfortable with it. So this will be somewhat of a review. If you don't need this, obviously you can jump ahead, but I'll walk you through each one of these. We've already done it, but I'll do it again with Walmart. So it'll be very, very similar to what we've already done. And then we'll see if it's too much like the previous video. I'll probably just have you look at the previous video. Right now, I can't remember if I did Walmart for the previous video. So if I did, I'll just reference that video again because it will be very, very similar analysis there. But it's good that you'll have to do this again with hopefully a different company. Now, it's possible that the firm your team is valuing is the same firm you did your financial application for the betas. So you can definitely use what you've already created. You do not have to come up with new numbers for that. You may have to update your risk-free rate, and use a new number there. In fact, in those problems, I was using some pretty old numbers that were much higher. But most of this stuff, with the possible exception of betas, is you have to walk through and come up with assumptions. Your team needs to somehow find a way to come up with consensus. And then your final product is a recommendation. And I'm only allowing you 2 recommendations. So usually the normal is strong buy, hold, sell, strong sell. That's the normal. For us, I'm limiting you to buy or sell. I'm not allowing you to say hold. You have to make a decision, buy or sell. You might say your firm is very well valued. Then look at your data table and look see if there's more upside than downside or whatever you want to do. But you have to come to the conclusion whether you want me to buy or sell this stock, because I'm going to actually set up a portfolio that's going to do your recommendations, and we'll monitor that over the spring semester and see how your recommendation actually does. So that's where we're going. So we will do this step by step, and it will take us a few videos.